Next guest here to break down how we should be investing around this. George Ball is Sanders Morris Harris CEO. He joins us now. And George, I mean, when we look at it, as we said, 745,000 initial claims there coming in roughly in line with expectations. But still, a lot of people might look at that number and say the underlying economy maybe not doing as hot as we would have hoped at this stage in the recovery. Of course, also Brian highlighting the latest thinking of the Fed there. What's your takeaway with how investors should be, I guess, hedging perhaps for the rest of 2021?
The investing public right now is worried, and the professional investors are worried that the Fed is behind the curve, that the amount of stimulus envisioned is perhaps greater than that which would be helpful over the next year or two to the economy. Putting it differently, it looks quite likely now as if we're going to have not just a vigorous, but an extremely vigorous rebound in the latter half of this year in terms of GDP, job creation, unemployment, profits. And the economy is like a great aircraft carrier. It takes a long time to slow it, to change course, to change the momentum, to change the direction. And right now, the $1.9 trillion, which is about half pandemic related and half of it is simply money to pump into the economy, could be in excess of that, which will be healthy for interest rates, for inflation, and somewhat longer term, therefore, for the economy. So there's a worry the Fed is behind the curve right now.
What does this mean for you from a strategy standpoint? When you're talking strictly about how you should be adjusting your portfolio, some of the rotations you're looking at?
First and probably foremost, you're seeing even today, when the NASDAQ is up, but only modestly, a very sharp transition out of the Fang and Friends big tech stocks that have been the leaders, the booming leaders in the market for the last 2 or 3 years. Conventional wisdom would say, buy the dip in the big tech stocks, buy the dip in the FANG stocks. I don't think it's right this time. Those shares were up by a lot. They're great companies, but the valuations were and are extremely high. I think there's a fundamental shift out of the more mature big tech stocks into different sectors of the market that would include new tech rather than old tech, but would include segments that have been well out of favor. You mentioned energy, and I think that parts of the energy investment mosaic will do very well, particularly the transporters, the MLPs that have done so badly. And I think there's one obvious bet, which is the two warring parties, Republicans and Democrats, can probably agree that infrastructure spending is a good idea, and there's some still moderately priced, not overvalued issues in the infrastructure sector that I think will pick up a lot of investment attention as we move further into and through this year.
On the downside, though, it's interesting to see in your note that you said a drop below 3,000 wouldn't necessarily be outside of the picture of expectations here for the S&P 500. And on the hedge front, also interesting to see you involved in the Grayscale Bitcoin Trust there. Is that the best way investors should be thinking about hedging if we do catch some negative wins, or is the VIX? What should be the playbook for hedging at this point?
The best hedge against a at-risk market is cash. Just plain is. Cash lets you sleep securely at night and take greater risks with the investments that you do make. With the cryptocurrencies, I think there is a fundamental hydra-headed shift that makes them very attractive as a small part of almost any portfolio. One is the longer term. If inflation is back, if we start to debase the currency badly, then the cryptocurrencies have a great deal of allure. Secondly, and this shouldn't be overlooked, as a speculative mechanism, it's quite likely that the cryptocurrencies, Bitcoin, Ethereum, and the like, will be the darlings of the very large retail market retail investor market that's gone from 5% of trading volume to 30 to maybe 35% of all volume today. So if the chatbot investors are losing money in common stocks but still want to speculate, then the cryptocurrencies, I think, will be the logical and likely next focus of their combined, individually small but combined very large dollars.
Interesting thesis there. We'll have to have you back on the show if we see those moves in the market. George Ball, Sanders Morris Harris CEO, it's good to talk to you today.